Hey guys, we're in our premium community, the Sniper Circle in setups. I'm going to take you into a particular equity that we're in. Marathon Petroleum Corp is the equity in question. And we do multiple time frame analysis and quite a bit of work in presenting an idea. I'm going to take you into a couple of the charts that we've done, and well done to the community for the win, those that posted the setup. That's progressing nicely. And just show some of the images in terms of the analysis that goes on in the premium side. We've been mentioning we've got 5 key shorts. All we're seeing in essence at the moment on the US equities in the last month is that we've been talking about individual equities falling to the downside. You'll see we have a kind of WhatsApp structure inside where we discuss. This was something I showed on Marathon Petroleum Corp. This is it by the way currently today. That's what it's doing today. We'll go more into that just now. And this is in essence trend setup, and we're looking for high maximization of the risk reward. This is the key element. How tight can you squeeze your risk? How expansive can you get your gain? Also noting in here, if I scribble a little bit on top of a scribble, is the fact that you had earnings-based announcements. And the interesting thing is, if you get the right structure into earnings-based announcements, you can win out. Also, by being early, note that we're on the rising wedge here. I'm going to change the color actually so that I can do this in a way that the new color shows over the red. That you have real rising wedge structure and what we call the shooting star pop out the top. So we started to get in early with that structure at that point. Why? Because we can have a very tight stop just on the other side of that red line. We can get our entry in there and then we can run it to the target, and we can even hold a little bit over for over performance if we sense that it meets our criteria for that. So we go into much more detail on that when we drop down. If you look, I actually went into detail about the shooting stars that went on one of a few platforms where I've been manifesting this trade. And the key element is, after our exhaustive shooting star that I've just referenced, what happened next? And the amazing thing is the market gives you chances. I talk about the train that sometimes reverses back in to get you. There was the first shooting star. We don't chase, you have real discipline. If you have real method, you can have real discipline. So we have sell limits, and the market came back and filled us. And it kept filling us on shooting stars. In fact, you got a couple of shooting stars, and you got the opportunity not to panic in, but to have markets above, entries above the order that then roll into profit. So the rally while you top out, there's that rising wedge structure, and it's all inside our overall setup that we're looking for, that's giving us a geometrically outsized asymmetric reward to a limited risk. So you can see the stops there. In fact, I went with the standard stops, but already on the extra entries. So we have another aspect. When we're really happy with the structure, and you really need to understand HVF method. So many guys following for free on YouTube, they're posting all sorts of setups, and some of them are godright awful. It's okay. I want people to think they learn something, but they're not getting the fullest out of it. The key element is you've got to be able to determine a beauty queen from an everyday setup. It's not just up, down, up, down, up, down with a pinch. There's a massive amount more that goes into assessing this, and I've done vids on volume by price and other things. But anyway, people will get what they will out of it, but the ones that invest get to see it executed and get to know the fullness of the training. This aside, you start to see the convex rollover that's taking place in here with regards to this. Repeated attempts to go up, that exhaust on shooting stars go up, exhaust on shooting stars, and they start to have a convex rollover. And that is the sign of the weakness. Further to which, while this met our other structure, there was a kind of level here, and in actual fact those entries, as you saw, had tighter stops. So we pig out. We have multiple entries only on those that afford it, that I pass on to the community. This is a really good idea that's been put forward by this individual. Let's lean on this one. We have others. They're still making their progress, and they're for the community exclusively, because those are people that value that and have invested in that. People that value things get the rewards. But this, in retrospect, has done, and as an example, I often get the guys saying, oh, but what, you don't tell us. You only tell us afterwards. Everybody wants people to throw pearls at their feet for free, and the concept is you don't value that if you don't see it as a pearl. You know, if it's thrown at your feet for free, it's just something you picked up off the floor. So the element of this is, here's the trade and here's the trade entries. This is what we've done, and this is what the community is executing in, and this is how they've been able to manage risk. And this is something I'm quite happy to share with those that invest with me through the use of one of many platforms. And this is important because it's also how you execute. You don't chase in. And in actual fact, with that, despite us still not being triggered traditionally into this setup, we did identify the 60 key level of significance, and I took a short there, and we had a small snapback rally. I didn't hold on to that entry. If there's a degree of uncertainty, I don't keep it. So it was put on and it was taken off for a small loss. And it's good, because you've got to manage money management really, really tightly, and the stops for each entry, the sizing for each entry must be less. The bulk of your position is put on in the beginning, and then you taper it down, and those stops must require a higher degree of compliance because they're coming later. And if there's any form of a rally too soon, they must be removed for a small loss. So getting in too aggressively also will work against you. And I'm okay with tapping to be full size. So we have a constitution which allows a bigger money management loss on beauty queens. And that's the element in my mind that is very important. And we're developing that theory out to permeate it through our community so that everybody has their own. Because you all come as different people with different degrees of tolerance for risk. So that's more charts with some things in. You can see how it's progressed there. The interesting thing is the market, after kicking back to this level over here, actually went quite convex, and in hindsight I could have maybe held on to it, and then it wound up. And this is classical technical behavior on our key level of significance. 60 is a significant number. It had spilled immensely from the original entries just south of 62 at the 61.8 in essence. How about that fib number? But just below, down to about the 61s, those entries. What do you get back? You have the rally attempt to regain the 60. That's what happened. You also had the looming earnings announcement, for which the market was giving you a key. So if I just do that, you have a look just exclusively at the earnings bit. Come on. And you can see estimate was 0.08. You can go away, bud. Estimate was 0.08, and they missed and brought a loss to the market. And it was in the DNA of the chart. Now, if you're wrong and it gaps the other way, and you don't know how to draw an HVF, and you're not getting the probability in your behalf, and even if you are getting the probability in your half, and you know that it's going to be event driven on earnings, you can have gaps that can take you out. This is why you have to totally be early and totally have your risk management under control. And many people don't know how to execute on this. So we also get into sharing some of the execution aspects of being early and getting in to the markets. So let's just have a look at how it's progressed. So this is kind of a rolling history, I suppose, of the charts. You can see that then that structure, I'm using different time frames now, that structure that I highlighted has now gapped down again, and is doing pretty much what it should do. Remember, it doesn't always give you exactly what you want in straight lines. Now I've gone and given you the whole view since the 4-hour time frame, which is illustrating the results, and this is on a daily time frame where you can see the entire channel assessment. So this had a blow off high up top here, and since then it's been in capitulation, slow trend, and then snapback rally, and then it gave us our structure to a high level of quality, and we were happy with it. By the way, risk reward ratio 20 for your entries that are in here. When last did you land 20 risk reward? And some of those stops are actually tighter, by the way. So the worst stop is on that level. When actually did you get 20 and speckle the top of a rising wedge? Well, you've got to have the confidence of the process, and you've got to know a good one from a bad. And that's the key concept of a community and proper training that actually appreciates everything. As I say, in the Twitter guys, they want to copy me in and show me what they found. We've got a premium community and I serve them, and that's part of the game. But we warned, and we do give you clues, the energies are looking a little weak, and the energy service companies. We have another that has a far higher possible RRR than 20, and it is already performing in a manner that is implying that there is great scope. In actual fact, if it did its target, and it's a big if, because in the same way, this hasn't done its target yet. What are we looking for? I'll share it with you. The target, so that you can all know, 46.49 to be run on Marathon Petroleum Oil. This other one, we're looking at a decimation of market cap, losing 7/8. Hey, you might say that's not very likely, and I'd agree. Generally, it isn't. But we've done this before. We've done this before on a number of equities that have seen entire decimations of market cap. And I'm not talking about cryptos, highly volatile. I'm talking about Gulf Sands Petroleum. We've done similar. Funny enough, there was also an oil environment. So I'm just a bit concerned for the overall economy, because I'm seeing oil service companies, and I've also been, there's a reason why it was 5 shorts that we kept seeing on our equities, our favorite 5 setups, of which I've now shown you one now that it's progressed. The key element seems to be that outside of the top tier fangs, that there is actually real weakness in the economy, and there's real weakness, and oil seems to, as always, as the Rockefeller tax, be early indicator to that. We've had yield inversion already. It's happened. You get maybe 2 to 6 months, who knows, before you get major recession. And nowadays, I don't think there's scope for small, shallow recessions, I have to say. Anyway, so it's interesting times. I could do something for you on the indice that would kind of be maybe a free takeout of my take of what might happen, how you might read, let's say, the Dow, for example. So why don't I just do that and try to give you some value on that? It's not a specific trade, but it is a kind of an insight. So there's a degree of triple topping, triple witching. I shared this also with the community guys, and I would say to you, we don't typically trade anything but our HVF method, but it's interesting to see the grain of this. And there's still the possibility that after a little bit of releasing some steam, we have a snapback rally tomorrow. So everyone is always driven by the momentum of the moment and just wants to pile on shorts. And what ends up happening is they often get taken to the cleaners. So you've got to be really, really careful about this. We could still have a final blow off equity market highs on the Dow, the S&P, and all of them that could see all of these levels taken. But at the moment, for me, I would argue that there is quite a big level here. It runs through here, and you've got the once, twice, and 3 times failure. Do you go up through it subsequently? That could still very feasibly happen. However, also, if we go into a full-blown recession, and this turns out to be, yeah, this is pretty serious, we're going down, then you could find yourself roughly from here around the 24,200, and this I would say takes you to about the 26,500. Let's call it 26.5. I gave slightly different numbers to my guys. I did it a bit more precisely, but 24.2. You'll have 2,300 down there. That'll bring you down to 2,200 here, which was an interesting place because you had an upside HVF there, which also gave you the 2,200 level in there. So what's happened is you kind of have a first floor and a ground floor. This is your typical range short, and then rallies typical range, short, and then rallies. Then you had super dip, which took you into what's currently a ground floor, although you can go -1, -2. And then the Fed did their famous U-turn that we predicted in Reset Sniper. You should all follow the Reset Sniper. We said in July that in October they would probably be there would be a major downturn in stocks, and that's the first knocking of the first time they raised interest rate. Will have 33 months behind the belt, and they ended up doing exactly that. Major snapback U-turn that re-put steam in the markets. You can check that structure over there. If you knew what we were doing, you could see whether that's been run yet or why it might support first here before breaking down. So you have to view it kind of as a ledge with the two stories. So this was a mega sell-off and this was a mega reinflate, and this has been the range. But this level has lent hard on that. Any takeout clearly of this level will probably lead to melt up upside in the equity. Failure to get back up to these levels and just weak soft rallies like bear flags like that later sell off could lead to the much deeper run of the ground floor that I've already indicated, where we have these three lines. So that's just a quick overview of some of the thoughts. So the market will tell us by whether it runs those highs or whether it flags off of these levels, and we have structure in here that throw down a lot of key levels of significance for us. Okay, so there you have it. You can see MPO for our take in it, and in fact I will bring it back up one more time for you. MPO, that's where I need it, sorry, MPO. And wrong one, MPC, sorry. So you can see what's going on here, and I said it was the into the 40s that it was going to be going down to, that's right, 46.25. So you'll get a view and a feel for how much further it's gone. But I want to warn you, for us it's just taken a second interim, and it can be some form of snapback reaction that can occur here. So the notion that everybody can just all pile in. That said, it is Friday, and Fridays are usually defensive days. People don't like to hold over positions. So the notion that it'll have a powerful rally on a Friday and everyone's going to commit money and be major buyers is also a bit flawed for Fridays. They're generally not, especially if you're having a nervous Thursday. So something to bear in mind. But don't chase in. You know, just because you've got the equity now, you can do yourself a damage, but it's our view that you will see the 46.25s-ish run on the downside as part of this. What will all the other oil and oil service companies do? Why is that happening? I think it smells like economic weakness. I don't truly know. Anyway, that's it for you. Ask yourself the question, when last did you potentially get a 20 risk reward? Well, let's make it 15. Let's say you weren't straight in. When last did you land a 15 risk reward? We haven't yet on this equity, by the way, but we have landed 60 plus, and there's another 60 plus out there that we're waiting for, that we're already in short and that we've got super tight risk. Are you applying method? And what's going on out there in the economy? Interesting questions. Oil related. Who knows? You know, who knows? But there's a lot of mid-tier equities looking real soft now. Why did we have 5 shorts, not 5 longs? Because the structure we're searching for is bringing us stuff that's on the short side, not on the long side at the moment. That probably means there's weakness out there. And that's a scary fact for us economically. I just don't see small recessions as being part of the game anymore. Okay, enough of all that fear-mongering. Enjoy your Friday, live life. It's not all about the equity markets. Have fun and learn what you want to learn from Freeview. And if ever you're serious, go to the website and check in for a chat or engage with us. All the best to you. And as I say, none of this is advice. It's how we look at the markets, and it's all down to you as to whether you want to take it any further. Enjoy. And whatever you do, always trade small, develop method as much as humanly possible. And get out. Don't be 14 hours a day on 9 screens. Lifestyle trader. Okay, bye for now.